You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike TOSAW from RCM Asset Management, Andrew the Rock Lobster Joe Venazzi from OptionFit.com, and Mark the Greasy Meatball Sebastian from OptionFit.com. The Option Block is brought to you by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. And now, get ready to hit the Option Block.
All right, everybody. It's that time of the week. It's Thursday, noon Central, 1 p.m. Eastern. Do you know where your portfolio is? Yes, it's time for the Option Block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network, as well, upon which you are hearing this fine program. If you can join us live every Monday and Thursday, noon Central, 1 p.m. Eastern. After the fact, legion of places, a veritable plethora of locations for you to get, including our app, which has everything baked in there. If you like to do deep dives, I know a lot of you do, then the app is probably the best place to go to get it all in one place. Otherwise, hey, we don't judge. Just send us those questions, those comments, those insights. We do love to hear you guys always throw us crazy curveballs and keep us on our toes, which is what we like from you guys. And let's see who's joining us today. It was Uncle Mike's turn to go on assignment on Monday. Today, it is the Pit Boys' turn to go on assignment today. So the Rock Lobster and indeed the Greasiest of Meatballs off. I gave them very, very difficult assignments, so hopefully they're enjoying those today. But we do have Uncle Mike back, joining us once again, back from his very perilous assignment where I sent him deep, deep down to the darkest depths of darkest Peru, sir. I'm glad you can make it back in one piece. How did you enjoy your assignment earlier this week, sir?
You know what? Peru is something else. If you've never been, then I don't know if you should go or not, because I didn't make it, Mark. I'm sorry to give you a bad report.
Isn't Paddington from darkest Peru? So you failed in our Paddington test, sir. So I'm disappointed.
I thought he was from England.
Well, he is the bear. I think the story of the bear is he comes from the darkest Peru. Something along those lines.
Oh, got it. Because, yeah, I remember when I went to England on a business trip, I bought my son he was a baby at the time, and I bought him a Paddington because it was something to do with England. So, anyway.
There you go. Paddington digressions already. A couple of minutes into the show. Marmalade, also a delicious Paddington-oriented treat. So by all means, enjoy. And someone's going to write in and say, actually, he was from Bolivia or something. Somewhere in the South American region. I believe, is where Paddington heralds from. And we're also joined over there holding down the Fidelity hot seat today by the Song of Ice and Fire himself, Mr. Colin Songer. Colin, welcome back to the show. Do you know where Paddington hails from, sir?
I don't. This is all news to me. I'm learning something new today. I love it.
That's what you tune in to the option block for. You're breaking Paddington news as we keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, not a lot really going on this week, so I think we'll just skip this part and go right to the strategy block. No, of course, I am joking, listeners. What a crazy week. What a wild week. It seemed like for a while there we could almost reuse a lot of the notes from last week because it seemed like the week was kind of playing out to the same script. Oh, my God, crazy news, sell-off, and then a rally. But yesterday kind of broke the mold with just extreme, shall we say, panic to the downside. You know, you've seen the news, of course, by now. Yield curve terror, inversions, dogs and cats living together, mass hysteria, everyone heading for the exits. That was, of course, exacerbated by very weak economic data coming out of China and Germany, two somewhat important economies that start with C. So all of that combining to really just spark pretty much the worst sell-off of the year, hot on the heels of pretty much one of the best rallies of the year. So the market giveth, the market taketh away. Today, the market was kind of struggling to find its footing for the better part of the early sessions. Now, coming into the start of the show here, it seems like we found our footing here, and most of the major indices are in the green, but ever so slightly taking some halting steps forward as they're trying to feel, is it okay? Can we rally? I don't know. We're kind of scared still. So a little bit of that going on out there in the markets. The Dow, after getting just the drubbing yesterday, leading the charge to the upside, what little charge there is, up not quite 1/3%, but pretty close. S&P up about 1/4%, actually just ticked exactly 1/4%, and the NASDAQ effectively unched on the day. Gold getting a little bit of a rally today too, not much, and oil coming off a bit. We'll get to more, of course. Oil and gold and all that good stuff, and of course a deep dive into equities. We'll have some special guests in the studio in a little bit. That'll be in about an hour or so, an hour and a half or so on TWIFO, so stay tuned for that. But man, oh, what a week it has been. And let's get into it. Of course, our old friend VIX Cash right now, let's see, coming in, VIX Cash hovering at about 2170 or so. So off not quite half a handle, but pretty close. Today it hit about 22.5. That was the high for VIX Cash. And this week, of course, was just a sea of volatility. Where it is right now, right around 21.5, 2160, it puts it up about 2 points from where it was last show, which was already elevated in the high teens and now still up 2 handles from that. VVIX, our old friend, the volatility of volatility, also up firmly just from our last show, up 9 points just from Monday's show. VXX, those of you who follow that, I know a lot of you do, also up quite a bit. Broke that beloved 30 handle to the upside and was trading there today for actually not close. It was trading 29. Actually, it was trading 30, about 30.30 today before coming off a little bit, 29.85, still right at that 30 level. The vol out there also just incredible, about 80% or so. A lot of you writing in saying, what's up with these prices out here in VXX options? Yeah, it's because it's volatile right now. That's pretty much par for the course. You want to pay $6 for a 30 put, goes out to Jan? By all means, go crazy. That's what you got out there, pricing-wise, for everyone who's kind of wringing their hands and saying, why? Why is it so expensive? Let's keep rolling. Things are lighting up the tape. Colin, maybe let's start there. Catch us up. I'm sure your guys' phones have been ringing just off the hook all week. This is pretty much the week that the strategy desk and the trading desk were designed for. So I'm sure you guys, no rest for the wicked for you guys. What was kind of dominating the discussion all week? Was it, as you might expect, all protection all the time? Was there something else going on? And then what's lighting up the tape in today's somewhat halting upside move here?
Yeah, it's almost like you can hear all the phone calls we get all week. It's crazy.
It's amazing how I do that.
Yeah, right. It was a lot of the focus was a lot of that fear creeping into the markets, people being uncertain. So that really has been a focus recently. What's been going on? Not all phone calls, but definitely a higher percentage that we've seen lately. Interesting enough, what customers are trading right now at Fidelity was the top spot was GE, with the headline of allegations of fraudulent financial reporting. Interesting enough, the Fidelity customers have a higher percentage of buy orders instead of sell orders at 58%. Right now, GE is trading at 805. It's down about 97 cents, which is 10.75%. So it's below all its moving averages. And the last time it was around this price level was January of this year. So, as you can imagine with the price movement of GE, the volume call to put ratio is sitting at one call traded for every 2 2/3 puts. So a lot of put activity comparatively when you look at the 90-day average, where it was 1.19 calls to 1 put. So it's inverted and double so. So a lot of put action there. Interesting enough with Cisco. So their guidance disappointed. There was some analysts that come out and cut their price targets on Cisco. Now that's trading right now at 47 spot one, which is down about $3.52. So somewhere just south of the 7% mark that they're down. It's below all its moving averages. Interesting enough, once again, Fidelity customers, 66% were buy orders for Cisco. Now, it was around this price level earlier in late January, early February time frame. Now, the call-to-put ratio is almost in line, just slightly below where it's 1.71 call to 1 put traded. Then we have some usual suspects like Amazon. Amazon made the list in the number 3 spot with 61% buy orders, trading at 17.79 spot 88. And it's up $16.43, which is just under 1%. It's just holding above that 200-day moving average. It's very interesting to see the activity on the chart. And it's right now holding above that level. So it's going to be interesting to see what kind of activity it's going to do, how it's going to react around that level. The call-to-put ratio is a little bit more, I would say, mute compared to what it usually does at 1.12 call to 1 put, when the 90-day average is around 1.32 to 1 put. Next on the list was Apple. Once again, usual that you'll see on there. And it's about half and half, just slightly in favor of buy orders going in. It's trading at 202 spot 15, and it was down about 52 cents. So not much action going on, just about 0.2% down. And the price just seems to just squeeze between this 20 and 50-day moving average. Interested to see what happens there. And, that call-to-put ratio is right in line with this 90-day average. That's right in there. And then we also, the interesting one that came across was Canopy that came on. They did their report of a quarterly loss of about $1 billion Canadian dollars. And they're citing that and distinguishing the warrants related to Constellation's $4 billion investment. Right now it's trading at $28.14, which is down $3.77, which is down 11.75%. So last time it was down around this level was once again in early January, and it's below all its moving averages. So the put the call ratio on this, so it's 1.16 calls to 1 put, which the 90-day average was close to 1.89 calls to 1 put. So that's what the Fidelity customers are trading so far here today.
So they're buying themselves some GE on this massive annihilation. GE just taking it on the chin today, I think is the technical term for that. We'll get into a lot more of GE in a little bit, listeners, because it is just lighting up the tape pretty much any way you look at it. Uncle Mike, I'm sure you'll be very sad to hear that news about Cisco, because I know how much of a fan of Cisco you are. So in addition to weeping over Cisco, sir, what else is catching your eye today?
Mr. Longo likes rubbing salt in wounds, so be it. Why is the market going down? Well, it's two main reasons, I think. It's we have the fear of a trade war that continues, and then the inverted yield curve. Now, the inverted yield curve is something that can be changed rather quickly, just depending on how bonds trade. I mean, it could stay the same for a while, who knows? As well as our trade war with China, that can always change very quickly too with one tweet. Combine all that with this time of year, volumes typically being a little bit lower. There's an old saying, sell in May and go away. Now, whether that holds true or not, we could debate that for quite a while. But one thing that's typically not disputable is that there's less trading that goes on during the summer months than what goes on between or after Labor Day and before Memorial Day. So oftentimes what you can see happen in the summer is if there's some quote-unquote bad news for the marketplace, it can be an amplified movement because there's less volume. There's less buyers and less sellers. So with that, the moves can be a little bit more volatile just because there's less volume in the marketplace. Now, we've witnessed that in the past. And so I think a lot of what had happened yesterday was a little bit of an amplified move in the marketplace. So with that being said, what are some ways with which you can prepare yourself to trade it and potentially profit from it or not lose a lot from it? We'll talk a little bit more about that a little bit later on in the strategy block. What's interesting about all this is that we're not getting a lot of awful macroeconomic or earnings news throughout this downturn. When you combine that with an elevated VIX or a VIX being above the 20 level, that could be a pretty good opportunity to do some option selling if you believe that volatility is going to go lower. If you think that there's going to be more volatility to come and you're an option seller, it's probably not a good idea. But if you believe that there's going to be less volatility in the future and that maybe this is just an overreaction to volatility, then this could make sense to be more of an option seller. One thing of note that I'm finding throughout all this, the price of silver has gone up. It's gone up, but people are thinking that it just feels like it's a very significant move. And for silver, I don't feel it's very significant by comparison of 8 or 9 years ago. Silver is the type of thing to where it'll go in the teens for like several years, then all of a sudden one day it's at $48 per share if you're looking at SLV. We haven't seen that yet. So the fact that we have not seen that yet, I mean, we've seen some upside movement in silver, don't get me wrong, but we have not seen the crazy major move in silver recently. So I think that's one thing with which to have an understanding of. One thing that we have seen a pretty decent move in, and that would be the bonds. If you look at TLT, over the course of the last couple of weeks, that's up over 10% in the last couple of weeks, the price on it. TLT rallied a little bit to the 130 level back in early June. Was relatively sideways, going between the 130, 132 level or 132 half level approximately. And then over the course of the last couple of weeks, it has just shot up. So with that, there's definitely a risk-off mentality in that buyers are making more of those buys. But I think that's kind of to be expected with the interest rate, what do we call it, banter that is going on between the president and our Fed, as well as just the rush to safety. Combine all that with the fact that we're coming off of all-time highs in the S&P 500, along with all-time highs when we are at a key number, such as 3,000, that's usually pretty tough to break through when you get to like a solid number like that. If you go back to some of our old shows when the S&P was at the 2,000 level, you heard me talk about the magnet market, how it seemed like it was a magnet to the 2,000 level. And right now, although I don't know if I want to call this a magnet market, 3,000 has definitely been a tough nut to crack. We've gotten over it, but not for very long. So you have a lot of factors in that case when the market's going or for doing what it is actually doing. Now, with that being said, if we do catch a rally, a lot of the economic news is fairly good overall, not necessarily lately, but overall, meaning companies are doing fairly well. We have a decent unemployment rate, so we could catch a bid, and we could actually start to rally from this. Now, whether we do or not, or how can you position yourselves in the time being, we'll talk about that a little bit more in the strategy block, strategically placed second hook for that. But a lot of stuff that's going on right now and a lot to look at. Very exciting to end the summer, to say the least.
Yeah, a little bit of a tumultuous dog days of summer here, which, last couple of years, August hasn't always been the sleepy beast that it usually is out there. August, certainly not a sleepy one this year, as we are pretty much halfway through the month at this point. Let's see a sleepy day, really not so much from a volume perspective. The market's having a hard time getting out of their own way to start the session here, but we're seeing the volume reflected therein as this lack of decision really generating a lot of churn out here. VIX, as of about almost halfway through showtime, lighting it up today, 485,000 contracts on the tape. The ADV has just skyrocketed over the last couple of weeks. Not surprisingly, we've seen big volume days out there. The ADV is almost 700,000 contracts right now, 690. Just a week or two ago, listeners, it was like 403,000 contracts. So up over 50% just in a couple of weeks out here, as we've seen some big days, including yesterday. Yesterday, as you might expect, a lot of action in the volatility space. The VIX options almost just a couple contracts shy of 1 million contracts on the tape yesterday, 990-something thousand. So a very active day. Today, also a very active day for SPY as we coming right on into the end of the trading block. Just a tick under 2 million, 1.99 million contracts on the tape. The ADV has surged to 3 million out there as well. So again, big move in ADV across the board. And yesterday, if you're wondering how much did SPY put up yesterday, 5.6 million contracts, so almost twice that ADV just yesterday alone. The S also having a busy day yesterday, almost 900,000. Actually, should say right now, having almost 900,000 contracts. The ADV also very strong, 1.4 million. Yesterday had a very strong day, 2.2 million contracts. Remember, the SPX, that's a big, meaty contract, so 2.2 million contracts. That's moving a lot of Vega. That's moving a lot of notional out there. That's a beast. And the Qs today, 432,000 contracts coming into the middle of the show here. ADV very strong as well, 732,000. Yesterday hit a clean million, pretty much 1 million even. And the Russell, aka IWM, doing 290,000 contracts towards the latter portion of the trading block here. ADV about 426,000. Yesterday, 611,000 contracts on the tape. And the Mr. Song of Ice and Fire there kind of buried the lead on what's lighting it up from an individual equity option perspective. I'll let you guess what it could possibly be. Let's start from the bottom of the top 10 here. Number 10, Microsoft, 136,000 contracts. Remember the other day when we saw, a big tumultuous day in the broad equity indices that we saw the top of the top 10 was, about that level, about 130,000. Wasn't that active of a day. Today on a regularly otherwise, I wouldn't say directional, a slightly upside day. We're seeing a decent amount of volume as maybe the focus returns again to the individual names versus the broad indices. Microsoft, 136,000. Number 10. Number 9, Beyond. Good old Beyond Meat, another favorite of the Fidelity clientele. 154,000 on the tape. Number 8, Netflix. $1.66 out there. Number 7, AMD. AMD, usually a perennial number 1, number 2. Not today. $1.70 on the tape. Number 6, Tesla. They've been having some challenges of late, shall we say, threatening that 200 handle now to the downside, which is makes those 100, those par puts we've been talking about for a while there, seem far more reasonable. Today, Tesla 215.60 off about $4 or nearly 2%. So getting ever closer, perilously close to that 200 handle. Hit 212 earlier this morning before the market started turning and it reversed itself a little bit. So all you out there who like to write even money puts out there, even number puts on Tesla, hopefully you have risk management in place. Hopefully you already have, because we've already had a big sell-off, but hopefully you continue to do so out there. Number 5, Cisco, Uncle Mike's favorite. Cisco, 218,000. Number 4, Baba, 226 on the tape. Number 3, Apple, a mere number 3 today. Shows you how crazy it is. 246,000 on the tape. Number 2, Bank of America, 360,000. And the number 1 with a freaking bullet, GE, coming into showtime, it had already done 5 times its ADV and 1.25 million contracts on the tape. Blowing the doors off it these days. It's also our most biased paper, but usually it's biased to the calls, these names out here, with 72% of Baba biased to the calls, but GE leading the dance to the dark side. 77% biased to the puts today. So just a ridiculous amount of paper. In fact, so much paper, we're going to spend some time on it in the odd block in a few minutes. But first here, let's kick on some other ones. There are a lot of still earnings popping off. I know it's macro all the time, but there are some micro names out there. We had JD, of course, Tilray going off yesterday, Macy's and Cisco, of course, on Wednesday. And today before the bell, we had some retailers, including one you may have heard of called Walmart. And let's see how they are lining up right now. Right now, they're at about 111, so up nearly $5 or about 4.5%. Let's see what they were pricing in according to the old earnings move report, which you guys can find for yourselves over there at theoptionsinsider.com. Click on that options news and articles tab, and you'll see the earnings move reports and earnings, all the sorts of earnings stuff. Scroll on down to today's one for Walmart. You'll see this report went up right before the open pretty much today. They closed yesterday at 106, about 106 and a quarter. They were pricing in pretty much exactly $5. And they, actually, I'm sorry, that's percent, 5%. And they delivered almost as we just saw, about 4.8%. And they're pretty much unched right now. So they pretty much came in exactly in line with their straddle, which is not something we see very often. There's a bunch of names in there. You also have the earnings season report, so you can see how the season is shaping up as well. And, of course, looking ahead a little bit to next week's earnings as well. There's a bunch of those with names popping off on the 19th and the 20th and the 21st. So if you're looking for, let's say, Cree or a bunch of other ones, Baidu out there, all those are in the report. Target, of course, still to come next week as well. All those are profiled in the earnings move report over there. Get at it, the options inside of. Meanwhile, got to get at some weirdo, crazy activity. Uncle Mike's down to parse it with me, so let's do it with a little bit of the old odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, we got to start here, listeners, on the odd block, because it's just, as I alluded to there in the trading block, it's GE is just dominating the tape today. GE trading right now, $7.91 off $1.12. Ticker symbol, of course, GE. You guys know it. You love it. But let's look back really quick. This one's on a tumultuous run for the better part of this past year. Now, of course, all sorts of problems plaguing this name. A year ago, they were trading substantially north of where they are right now, roughly 50-odd%. They were trading about 12 and a quarter. That was, of course, about last August. They got up to about 13 and three quarters or so. That was the high back in early October of last year. Then we all know what happened later into October. Things started selling, and GE joined the slide on the nadir. Actually, their nadir came, looks like, not on Christmas Eve, but on the 12th. With their low of the number of the devil. 666 was their low back on the 12th of December. They slowly rallied from there. They actually traded almost $7 on Christmas Eve. So their low of the year wasn't Christmas Eve, unlike pretty much every other name in the market. And they kind of rallied back up to about 1060 or so in early February. Looks like things were going good. And then they kind of sold off a little bit again back to 9. And they kind of bounced in this range from about 9 to about, looks like about 10.5 on the upside. And back and forth, and we're back down through that low now, 9, breaking through the 9 floor now, down to shy of 8, 790 here on this latest surge of news that Colin was mentioning to us with all sorts of issues in their stable. So not surprisingly, GE lighting it up today, the biggest prince, the biggest trading name out there in individual equity options by far. And so we thought we'd just look really quickly and see what the heck is dominating the tape. And there seems to be a few trades, Uncle Mike here, that are really dominating it. First off, we have, looks like a three-legged, three-way put spread, maybe a roll, dominate in most of the tape. We got 22,571 of the SEP 965. It's really a put spread. It's not really a fly. There's no ratio to it. It looks like, if I had to guess, maybe they're rolling because the 6s and the 5s are both opening. The 9s are not. So maybe they're taking the puts that are now firmly in the money, over $1 in the money, and rolling them down to some strikes that are a little bit less in the money, shall we say. Oddly enough, if it is a roll, they're not going out a little bit. They don't want to keep the party alive for much longer. They just want to maybe take some of their profits off the table. Either way, looks like they dumped those SEP9 puts for $1.31, which was pretty much right off the bid. And then looks like they bought the SEP6.5 put spread for a dime, so doing the whole thing for $1.21 there in a credit. Again, 22,571 times opening on those latter two legs. I would guess that. Maybe Uncle Mike has a different interpretation. We shall find out. Also, worth noting, it wasn't just those puts. In terms of the single strike and option that had the biggest action today, or has the largest action today, it's the AAPL puts, with 36,000 going up in just two trades. One 19,000 lot for 44 cents actually through the offer. That happens. I talked yesterday. Maybe you haven't heard it yet because it is on the Huddle episode for Options Playbook Radio. You'll hear it soon. Trust me, listeners. I talked about some of the crazier things I've seen out there in the options market, and the day that Intel really sold off, how people were just surprise, paying anything they could to get some puts. Maybe a little bit of that going on here as well, paying through the offer for these AAPL puts 19,000 times, and then lifting the offer again a little bit later, about 15 minutes later, for another 17,192. So total of 36,000 just in those two mega blocks. Those not opening, which is interesting, but again, there's a ton of OI. There's 134,000. So it's kind of like VIX. You're kind of trying to read for the shrubs through a bunch of very tall trees on these strikes that have a ton of open interest out there. But either way, a lot of put action. Uncle Mike, not exactly surprising that there's a ton of put action out there in GE today, but maybe some of the strategery being utilized out there is a bit unusual. Do you concur with me? Do you think that guy's rolling down from the SEP9 puts to a put spread? Do you think something else is afoot? And do you have any other thoughts on just this downside palooza that is lighting it up in GE? I'm assuming, given its level of risk lately, the GE not part of your strategic night, sir?
I don't believe it is, but they could always change it at any second. So I'll leave it at that. But no, I don't think it is. But I agree with you in terms of the roll from the in-the-money put down to the put spread. I like to think of this as like a cherry on top of the ice cream type of trade, in that you got the ice cream by having a big profit, likely. I mean, you don't know where they got into it at. But let's say that you just have a single leg call option or put option. It goes your way, and you have a nice profit, but you're like, man, I really don't want to do any more with this, but I'd feel real dumb if this went the other way on me and I didn't take anything off the table. That's when you're trying to be greedy, and greed isn't necessarily a bad thing if it's handled properly. Now, what do I mean by that? We're humans. We all tend to have to deal with greed and fear. Those are the two enemies of investing. But if you want to handle them, let's say that from a psychological standpoint, you just can't handle the fact of not making any more money if GE is going to continue to go down. But on the flip side, you're like, shoot, if GE goes back up and I don't take any profits on this put, what do I do with this? That's a point to where a roll like this, I think, makes a lot of sense. If you're indecisive and you can't really make a decision, you can sacrifice a little bit of it with options. So if the fact that the cost of that put spread was 10 cents, well, then the way you walk away thinking of it, you're like, well, okay, if GE goes back up higher, then I took my profits and I only risked 10 cents. However, if GE continues to go lower, you're like, well, I paid 10 cents for this. I probably didn't get quite all the downside that I did before, but I made a lot of money off of 10 cents of risk. And so rolls like that I really like, because we can try and say we can control greed and fear all we want, and just eliminate them. Don't have any greed, don't have any fear. Well, I don't think that makes a lot of sense, because that's something that we as human beings have been trying to control for thousands of years, and it really hasn't worked yet, or for very few people it actually works. It's there, it exists, and by doing a move like this, that's the beauty of options. You can actually embrace your greed, and it only costs you 10 cents to do it, and you still have a little bit of skin in the game, but it doesn't really cost you a lot of money. So that's what I like about trades like that. And if that's the mentality of the person who is doing that, I really like it a lot.
And that's why I like having Uncle Mike in the strategy block, because I toss him a put spread, and he somehow rolls it, pun intended, into a little life lesson there, which is always fun. Let's keep on rolling here. Let's see what we've got. Some interesting names on the odd block today. CBS also lighting it up. Kind of a bit of looks like a polar opposite of what we just saw. Everyone's scrambling to get some downside. Here, looks like someone got some love, got some upside love. Let's see here. CBS, of course, trading today, 43.32, off about $1.30, nearly 3%. Over the past year, a year ago, they were trading 52.80, so almost $10 north of where they are right now. Looks like they rallied up to their 52-week high of around 59.5 in early November, actually. That was probably the height there. And then they promptly sold off shortly thereafter. They hit about 59.5 or so. Then by, of course, the dark day of Christmas Eve, they were trading 42, pretty much not that far from where they are right now. And then they turned right around, got up to about 50, almost 52 again by mid-February. And then they sold off again to 45 by about a month later in about mid to late March. And then rallied up again to 52 again by about a month later in April. So, yeah, kind of a bit of a range of about 10 handles or so to the upside, to the downside. Hit it again in mid-July, and now they're selling off again pretty hard over the past few sessions down to where we are right now, 43.25. But all that, maybe someone looking at that chart saying, they're poised for their next big up move, because it looks like we got some call love here. A little bit longer term, too. It's the March doubles. So remember I said we're at 43.25, so these are a wee bit out of the money. March doubles, 10,000 times, going up for 76 cents. These were 50 cents at 76, so someone taking all that offer 10,000 times. This was opening. Of course, there's going to be some earnings between now and March, and the next earnings cycle, October 31st, so Halloween, spooky day for earnings. So interesting. We got some call love. Hard to see if there's any size stock going up with this. Uncle Mike, this is kind of old school odd block. We don't see a lot of this. Maybe the difference is it's a little bit longer term than what we see out to March. But other than that, it looks like it's some straight up upside call love, paying 76 cents, 10,000 times for some March doubles. So someone's betting on a nice quick reversion back to the upper end of that recent band. Is that your takeaway as well, sir?
I would say so. But before we get into that, just for the members of our audience and myself who never traded on the floor, can you help us? What does the doubles mean?
I'm sorry, 55. 55 calls would be the double call.
Got it.
So yes, sometimes that lingo sneaks its way in. You forget it. It just flows so natural.
You do. But I was never on the floor, so that's a bit of camaraderie that I cannot say, but just wanted to clarify everything, just for everybody involved. I think it's that. The other theory behind it is that someone may have a bunch of short shares of stock, and of course they could be using that as a hedge for short stock. But typically, I really don't see that, because a lot of times people who short stock don't usually want to hedge short stock, and it's usually you're better off just simply buying puts. I could be wrong. You might have short stock benefits in terms of the payment on it that may exist, but ultimately, most people who are bearish usually use puts a lot of times, or I think that's just in my opinion, a more efficient way of being bearish on something. So, I think in this instance, it's definitely someone that's taken a flyer on something, and they want to see where it'll be, because it's a long way to get from where it is to the doubles, as Mark says.
The doubles. Well, we're not done with the doubles yet. We got more doubles in store for you, this time out here in AEM. This is Agnico Eagle Mines Limited, ticker symbol AEM. Trading today, 59.32, up about $1 or about 1.5%. And this is the name a year ago was trading well shy of where it is right now, trading 35.5, and it's kind of been on a long slog to the upside ever since, spiking from 40 up to about 46 in early June, and then again up to 52 a week or two later. So June, good month here for this mining name, and then they continue to rally to where they're at now, threatening the 60 handle as of today. I'm going to go out on a limb and think they have something to do with gold mining, given their recent run, and looks like that is indeed the case. They do some gold mining and exploration. Now let's see what we got out here. Someone maybe deciding this recent run a little bit too much. Maybe they're concerned. They got some profits in their back pocket. They want to lock those bad boys in. Either way, we got some more doubles, this time double put love in November. The no double puts, a.k.a. 55, as Uncle Mike so kindly reminded me. Going up 7,567 times for $255 right off the offer. These were offered at $260. They gobbled them up for $255. This is opening on the NAM, the NASDAQ options market. Worth noting there is some earnings in there. October 23rd is when the earnings is. So, Mr. Uncle Mike, this makes a lot of sense when you look at the chart here. We've seen a nice steady run up over the course of the last year. There are earnings coming up. Maybe this lift for gold, maybe he's concerned it won't hold. Either way, he's looking to lock in what he's got. He's paying a fairly hefty premium for it. He's paying $255 to protect himself at the double strike all the way out through NOV expiration. So he's protecting himself down to about 52.5 or so. So interesting choice. Do you like this as a hedge, sir, or would you prefer a different construction?
I mean, typically, I'm more of a fan of a vertical spread for a hedge, unless I want some type of catastrophic hedge. And then, if I'm that short term in my hedge, usually it means that I like the underlying long term. And if I'm short, if it's something where I still want to hold on to it for the short term, and by short term I'm talking less than a year, if I want to hold on to something for a greater period than 1 year, that's more of a buy and hold type instrument for me. I like doing a put spread, because if I like it for the longer term, then you might say, well, Mike, what if it goes below your short strike on your put spread? Well, I would say, well, if I like the stock at double or 55, then I'm loving it at 40 because I have a longer term time horizon on it. And if I want to just have a shorter term hedge, then I think it makes more sense, at least for me, to buy a put spread at, say, maybe the 55.45 or the 50.40, something like that. And then if it gets to a certain level, just take profits on the put spread for the near term. If it's something to where I want to have more of a longer term holding on it, or I'm sorry, more of a shorter term holding, and I'm just concerned with something more catastrophic, then usually, not always, but usually what I'll end up doing would be to have more of a catastrophe type of hedge type of thing. So, yeah, I definitely think looks like it's a hedge in some way, shape, or form, but that's how I like to do it.
All right, as we keep on rolling, Uncle Mike missed his Monday dose of strategy, and he's champing at the bit. He can't wait to get at you. So we'll get a special Thursday edition of the Strategy Block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
All right, welcome to the Strategy Block. You guys know the drill. By the way, Uncle Mike, looks like we talked down the market over the course of the show here, because I remember I said the worm had turned a little bit. Things were looking slightly up, about a third or so to the upside. Not so much now. Most of the major indices turning into the red, off about NASDAQ off almost 0.5%, S&P off about 0.15 or so, and Dow about a similar percentage. So interesting stuff. Looks like we spooked everybody, Uncle Mike.
I bet it's the rock lobster and all those main option traders. I bet they heard us talking, and they're just out of spite shorting the market. That's what I think it is.
That sounds highly feasible, sir.
Yes, for sure. I want to do a somewhat repeat strategy block because we're having a somewhat repeat market today. I want to talk about when a vertical put spread goes against you, like they've been going against me the last couple days, and how I like to look at things and how I like to make adjustments on them. Now, I'm a fan of, from the school of thought that I don't like making too many adjustments. I really believe that the reason the term adjustment came about was from back in the old days, before online trading, and you had to call up your futures broker or your option broker or whatever to make trades. And let's say an option went against you, and the person had discretion on your account, then they would just sell one option, buy another one or whatever. And then instead of telling you, when you call them up and you say, hey, how's my account doing? Instead of them having to tell you, the trade totally went against us and we had to sell one option and buy another option, they just say, oh, well, we made an adjustment. Sounds a lot better. So keep in mind, that's just my theory of where the term adjustment actually came from initially. So with that being said, have an understanding of when you have to make an adjustment and you're losing. Understand that you're in a losing trade and really embrace that, because if you don't, then sometimes you might become guilty of taking the the tainted drug hopium or wearing the rose-colored glasses. So I have 2 rules of when I sell verticals. Rule number 1, don't let them go in the money. Rule number 2, don't forget rule number 1. The only time that you're ever going to see a vertical go in the money that I'm trading is if it's an overnight gap. It will not go in the money during the day. I actually have standing orders on my verticals right now to where if we hit a certain price, which is the short strike price of the short leg of the vertical, to just get out at the market. And you might say, well, Mike, our market order is bad. Well, I say when you're trading SPY, really you might get gypped on a penny at the most, but usually I don't. So that's why I got to trade liquidity. If you don't have liquidity, then you don't have me as a trader. That's just how I do it. So with that being said, the benefits of selling a vertical are not only you have limited risk, which I think we all understand. If you sell XYZ is trading at 40 and you sell the 30 put spread, you have the limited risk because if it goes below 30, you're not going to have any more risk on it to the downside. But the other benefit that I really want to emphasize, especially with the market action we've had recently, is that of volatility. Typically, put options, the further they are out of the money, meaning the lower the strike of the put option, the more volatility can actually affect them. So here's how this can benefit you when selling a put spread. If the market goes lower, volatility a lot of times goes higher. And so with that being said, the long leg of the put spread, the protective leg, can rally in a pretty decent manner to make it so that when the put spread goes against you, it's really not biting you too badly. Now, that's the case if you follow the Uncle Mike vertical trading rules of never letting the put spreads or call spreads, if you're doing the other side, go in the money. And so that's what I think really can help you. Now, the other benefit of volatility when a put spread goes against you is, let's say you need to roll down. A lot of times, because of the fact that those out-of-the-money put options will have a volatility rally on them, doesn't happen every time. I'm just kind of going by my judgment and what's been happening to me the last couple of weeks. You can sell a put spread at a lower level, i.e. an adjustment, after you get out of the one that just went in the money. And the credit that you get, although it will be lower, it's not going to be quite that much lower than you'd think it would be. So by doing that, you can kind of take your lumps a little bit, maybe get in, get out, and as Andrew would put it, do stuff over the course of a few weeks, and then maybe kind of get back to where you were from the beginning rather quickly, meaning in terms of profit and loss. Does it happen this way all the time? Good gosh, no. If you kept doing this in November or December of last year, then this wouldn't have ended well for you, just because you can roll the put spreads down, but you can't roll them down forever. I'm typically more of a fan of just rolling them down in the same time frame. Reason being is that if we stay the same, then it obviously benefits you because it's going to expire sooner. But also, if we do get a little bit of a pop, you have time decay and volatility working in your favor, and I really like that. You can still have time decay working in your favor if you do a down and out roll, meaning you close out the one put spread because it's getting ready to go in the money, and then you sell another one with a lower strike price but a further time frame. I mean, that's a popular roll down method as well, and I do that at times, but usually my first choice is to stay in the same expiration cycle. So that is my take on selling put spreads in a market like this. And I'm going to turn it back to the big cheese himself, Mr. Mark Longo.
Thank you for that, Uncle Mike. Speaking of cheese, let's see if our listeners got any tasty cheese for us to do a real quick delve into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the mail block. We got time for a quickie here. Let's do a quick quickie. I like this handle, so he gets picked. Lucha Boy says, is it reasonable for me to expect to get filled at the mid all the time, or am I being unreasonable? Mr. Song of Ice and Fire, I'm guessing a lot of the calls you get when they're not calling up about hedging in weeks like this are about, hey, I got executed here. Why is that? Customer expectations of execution can sometimes be not exactly reasonable. shall we say. They always want to buy the bid and sell the offer. So what do you have to say for Lucha Boy? Is he reasonable to expect to always get executed at the midpoint, sir?
Yeah, I'd say that's not reasonable. I think what Uncle Mike was key in what he said about, it really depends on liquidity. Something like SPY where it's a penny wide, you don't have to worry about the midpoint because it's such a tight market that it is what it is. It's not going to trade in a half penny for you. But for the most part, when you're trading, whether it's spreads or any kind of strategy that you're trading that has multiple legs, there's a lot of factors that go into it. And would you reasonably be able to expect to hit midpoint every time? No. I mean, there's going to be times where if it's less liquid and obviously if there's not this is summertime, right? So lower amount of participants in the market. It's going to be a little bit tougher to get that midpoint. You want to put all those factors into play when you're doing it. It's always, there's nothing wrong with always starting at the midpoint and then working your way, whether towards the bid or towards the ask if you're towards the bid if you're selling or towards the ask if you're buying. But there's nothing wrong. Test out the waters. Throw it in at the midpoint and kind of, if you have the time, work your order from there. A lot of that also is going to be, how much time do you have? If you don't have a lot of time, look, just put it where the market lines up. See if you just get your fill. If you have time to work the order, yeah, try that midpoint, see what happens. But I wouldn't say that it's reasonable to expect to get it every time.
Uncle Mike, you were just talking about this, so what do you have to say for Lucha Boy here? Is he being reasonable or unreasonable, sir?
Well, I definitely don't think it's realistic to expect that. The only thing I would add to what to do with this is whenever we've traded in the past, like RUT or SPX or something like that, sometimes what we would do is we would put out what we referred to as a scout, meaning let's say we were trading 200 contracts of it. We would put an order out for maybe like a 1 lot or a 2 lot to see if it filled at a really good fill price, just to kind of see where it was. And that's when the bid-ask spread is going to be a little bit wider on those. I mean, comparatively speaking, it's not really that wide because it's that much bigger of a contract. But just when you look at it, the bid-ask spread sometimes can be a little bit wider than what you like. I would just say if you're trading a 10 lot, then maybe try it with a 1 lot, and if they accept it with a 1 lot, then maybe you can start scaling in and adding more to it. That's the only thing I would add to that.
Well said, sir. So, Lucha Boy, do not be unreasonable, and definitely, as Uncle Mike was alluding to earlier, maybe hang with some of the deeper, more liquid names so you could have a more reasonable expectation of getting filled somewhere around that midpoint. If you don't, the markets are pretty tight anyway, so you're not really getting hurt a penny or two in either direction. It's not going to kill you versus some of these ones that are very wide, shall we say, and then all of a sudden that midpoint becomes very far from the bid and the offer. Meanwhile, we're not that far from the end of the show, so let's get into it with Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, listeners, this is where we tell you what we're watching for the rest of this week into the weekend. Once again, we go back out to that Lord of Westeros himself, the Song of Ice and Fire, a.k.a. Mr. Songer. Colin, what are you watching for the rest of this week into the weekend, sir?
So it's going to be curve. So I believe it was actually Uncle Mike that we were talking about this before about, backwardation on the VIX futures. I think it was Uncle Mike that I was talking this with. It's very interesting to see it's getting closer to a more normal, but a backwardation state where it's not as a funky curve that we were seeing last time. So that backwardation really showing up in the VIX futures there. And I'm going to be focused on the yield curve. I mean, it's all over the headlines, so you can't really miss it, but it is something to keep my eye on. And all of that's really going around, all these, the Hong Kong protests, what's coming out with that, and then China and U.S. going back and forth. So, interesting enough, I also wanted to point out is that it's interesting to see, with what's going to be happening with the S&P right now. We're at a kind of a very interesting level where the 20-day moving average is just barely holding on above that 50-day moving average. So it's going to be very interesting to see where we end up, because if there is continued selling pressure on the S&P, one of those, the 20-day could possibly cross over from above to below that 50-day moving average. So it'll be interesting to see how that plays out. And really, the next, what we're looking at is, it's still above that 200-day moving average. So is it going to start making its way down there to test out that level? So those are the things I'm really looking at.
Uncle Mike, same question for you, sir. What is dominating your tape on these crazy, crazy days?
What he said, along with the 2,800 level of the S&P /280 level in SPY, I think that could be a level of support. That's what I'm watching.
All right, listeners, unfortunately, that music means we're done. If you're saying to yourself, hey, I need more. I need more market insight and analysis to carry me through these troubled times. Don't worry. We got you covered. We'll be back here in exactly half an hour. Talk all sorts of good stuff. Volatility, deep dive into volatility on the equities with the TWIFO show. We got some special guests coming in the studio for that. And in between, we'll actually, if you like yourself a little bit of Apple, a little bit of catastrophe puts in Apple, stay tuned. Maybe we'll have an OPR heading your way in between to discuss that exact topic. So all sorts of good stuff. But before we go, let's go back around the horn. Our friends at the Pit on assignment today. Check them out. OptionPit.com is a place to go. I know they're doing a lot more on the YouTubes these days, so maybe search for Option Pit and subscribe to them on YouTube. You get some good stuff. A lot of you are subscribing to us now these days on YouTube. We don't really put any content out there yet. You're welcome to subscribe. We won't hold it off, but maybe, given the interest, we'll kind of redouble our efforts to try to get you some interesting stuff on the old YouTube. At the very least, get all of our shows going out there in an easily digestible form. Right now, it's only a handful that go out kind of on an automated basis. We don't really do anything with it. So, but if you like that, we'll try to make more available to you. Clearly, you guys do. So we'll try to make more for you. And Uncle Mike, I know you don't have YouTube, but what do you got going for the folks over there in stcharleswealth.com?
All sorts of crazy things now. Feel free to contact me if you look for an advisor that kind of gets excited in markets like this for all the opportunities, as opposed to not answering his phone and avoiding people. So I enjoy times like this, and that's what I like. Call me.
Call the man. Or look him up, stcharleswealth.com. Click on the fox to unlock the secret to riches. I'm just kidding. Don't get his compliance mad at me, but head on over to the website. Nonetheless. And last but not least, Mr. Song of Ice and Fire himself, before he heads on back to the Iron Throne. Mr. Songer, if folks want to kick the tires for themselves over there in Fidelity Land and sling some options, where should they go? What should they do?
Yeah, so they should check out fidelity.com/options. Goes over the different tools to help them with their analysis, as well as the different services available, including online classes that our desk teaches. So certainly check it out. And on top of that, if you want to have a discussion about your approach to trading options, option strategies, or even reading charts, or just general concepts in the market overall, you can always give us a call at Fidelity at 877-907-4429 and ask to speak with the trading strategy desk, or even me directly. You can always give us a call, and we're here to help out.
Yes, do exactly that. Call that number and ask to speak to the Song of Ice and Fire. They'll know. They'll know exactly where you're coming from. So it won't be hard for them to put two and two together. And on behalf of Mr. Songer and Uncle Mike and the Pit Crew, and indeed myself, I thank all of you out there for downloading, streaming, subscribing. If you're listening live, stay tuned. Good stuff coming at you in the interim, and then more coming at you right after that from the studio here for TWIFO. Otherwise, we'll see you back here tomorrow for Volatility Views. Got Simon back on, the Spike's father himself, so that'll be kind of fun. That's at 1 p.m. Central. Then we'll see you back here on Monday to do it all again on the Option Block.
The Option Block is brought to you by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.